Well, Dalal Street sees its longest winning streak in 2024 after it saw gains for the 6th straight week. Benchmarks outperformed the broader markets. On the Editors Roundtable, we give you the bull and bear case for IT stocks, Q1 decoded, and what to expect from all sectors this earnings season. And we put the spotlight on retail participation. I'm Sonia Shenoy. Joining me today, Nigel, Nimesh and Rima. Also today with us in the studio this week, we have Gautam Chowcharia, the head of global markets at UBS. Gautam, thank you so much for joining us. It has, guys, indeed been a really good week for the market. The bulls were back on top and, good earnings coming in from TCS. So the recipe was there for the markets to have a field day.
And, we were consolidating and it just felt like, perhaps today also we'll consolidate. And then there was this big move from the IT stocks. And that felt like the markets are breaking out and we went on to hit record high levels.
It looked like today we might have a big breakout because yesterday, inflation cooled off in US. While the Nasdaq was down 2%, but TCS clearly was a big surprise and expected, given the positioning in the IT sector, it was expected that you'll see a lot of short covering as well. So, and for the last few days, it's the Nifty and the large caps who are having a party now. The mid caps have relatively been on the sidelines. Actually, this week at a portfolio level, I'm sure a lot of investors would be not enjoying that much because it's all about large caps and technology, and that's where the positioning was not very high. So, and this is expected, right? You are going to see a bit of sector churn as well. So, I guess clearly a sector churn happening. Today was a day for IT. This week we saw a big move in one of the days OMCs as well. So that's going to be the trend, I guess, for the next few days. Until the budget, I guess that's going to be the big trend that you'll see a bit of sector churn, and maybe the large caps will lead the rally at least in the near term.
That's right. And Reliance Industries, that's come back in good form. I think it hit that 3,000 odd mark in February, and after that it didn't do much. And suddenly, in the last 1 month or so, it's come back to its own, and now it's moving higher. So maybe a fresh breakout on that one. And that's as good as any constitute on the index with its 10% weightage on.
And also next week you have Reliance's numbers on Friday. So that's going to be the big talking point. But Gautam, thank you for joining us. Welcome to the show. And welcome back to India. I mean, you've had that big move to India. So I guess India is the hot spot once again in the Asian markets.
India has been a hot spot for long. But it's become the obvious big hot spot in the last couple of years. And for the right reasons. We're seeing enough growth, not just for near term, but I think what's changed is the comfort for global investors about the runway for growth. And the other subtle point which I keep talking to investors is that now the scale is big enough for India. So it's not just growing 7%. So you grow 7% of a 1 trillion economy versus growth of 7% of a 3.5 trillion economy. It's a very different thing for global investors.
But are you sensing a mood change from the FIs or the FPIs? Because you were in Hong Kong for the longest time. So you have a great perspective on how FIs think. And the FIs were sellers in the Indian market. It's just in June and July that you've started seeing them buying. So is there a mood change?
So look, I won't call it a mood change necessarily. When you say sellers, you have to remember two things. One is emerging markets in itself. Emerging markets as an asset class has not been getting big flows. So when emerging market asset class gets outflows, you don't take a call on whether to sell India or not. You have to sell. Okay, so that's one thing to remember. Second is early in the year, there was a tactical opportunity which many global investors, emerging market investors were looking at. China had become too cheap. And they were worried about what happens to elections. So from a tactical perspective, it was a trade. But again, the numbers involved, the selling we saw in India, is peanuts in the scheme of their investment which they have in India.
Gautam, I wanted to ask you about this. India appears, you're sitting in a car, you've got a lovely highway, things are looking up. But at some point of time, there's too much of air in the tire. And then maybe you deflate a little bit and you continue that pace. Do you think that time has come, for good reason?
So we have seen enough market cycles globally and in India. It's difficult to time these things as to when is the right time to deflate. These happen, it's a market-driven market.
Yeah, we don't want the crash. That's why
so exactly. So it's better that market drives its own balance rather than trying to consciously deflate. That can sometimes be not perfectly timed. So I think obviously market forces will play a role. Like what happens when market becomes extravagant? You see more capital raising, more cheaper capital available to businesses. The quality of capital raising from the quality of businesses starts coming down. And then the demand supply finds its own equilibrium. So those are a classical way of market clearing the market froth, and then you can try proactively.
So you're bullish at these levels also?
The bullish, again, two ways. If it's short term, you can't see any reason why not to be bullish in terms of market momentum, given the flows. Fundamentals, valuation-wise, there's no disagreement across the board that valuations are rich at a broad market level. But are they at levels which reminds you of .com or GFC? Then no.
No.
Because the growth visibility is there.
Okay, well, the big headline this week was TCS's numbers, right? Kicking off their first quarter numbers, good set of numbers coming through. Management commentary was also positive. Rima, you have a bull and a bear case scenario for TCS.
Yes. So actually, the Nifty IT index was the best performing sectoral index this week as it closed up with a gain of nearly about 4%. TCS led the charge in the frontline pack. So we thought it's a good time to put forth the bullish and the bearish argument. So let's start with the bull argument. Are we at the beginning of an earnings upcycle or an upcycle for the IT stocks? Is the worst over? Some reasons. One, very strong numbers from TCS, a beat on revenues, a beat on margins, and even BFSI, which was under pressure for them, has clocked in a positive growth. It's a modest growth, but after 5 quarters of a contraction sequentially, this time BFSI has thrown in a little bit of a growth. The second reason is that the IT stocks have gone through some time correction. They've not given you any return over the last 3 years. And the third reason is that IT stocks are very sensitive to the global interest rate cycle. So when interest rates rise in the US, you saw IT stocks underperform. And now there is hope that perhaps in September or November, interest rates in the US will come down. And typically, IT stocks globally and in India react to that positively when the interest rate cutting cycle begins. So that's the bullish argument, which makes a case for stocks to do well from here on. But on the bear side, right, analysts are quick to point out that yes, Q1 was fine for TCS, good set of numbers, but the management is still very cautious. They're not confident to call out any recovery or turn in demand. We quizzed them many times on the discretionary demand, but they're saying it's not deteriorated, but it's not come back. There is no visibility. So the management is still cautious, and they're not talking about demand sustaining from these levels. Also, history tells us that even if stocks do well, right, over the last 1 month, 3 months, but if it's not backed by earnings, you quickly see the stocks being sold into. And these are stocks which have done very well in the last, 45 days. In the last 45 days, names like Wipro are up 25-30%. HCL Tech too has seen a 17% return. And the final argument which the bears are making is the valuation. The Nifty IT is trading at a 30% premium to the Nifty, higher than the historical averages of 20%. And it's not that the Nifty IT EPS growth, at least for the large caps, is going to be so much more. The Nifty IT is likely to see an EPS growth of 10% over the next 2 years, which is in line with the Nifty EPS growth. So therefore, there is no justifiable reason why the Nifty IT should trade at a premium to the Nifty. So that's the bull versus the bear argument. But let me throw this question across to you, Gautam. Where do you stand on the IT argument?
So look, our strategist is still neutral. Our IT analyst is much more constructive.
Okay.
But again, you have to remember, IT sector is much more about the marginal negative surprise versus, say, an industrial or consumer sector. The delta is not that great. But at the moment, again, today was one of the big guys' results. We can't talk about Indian names, but we saw some early signs of that positivity building up. And specifically BFSI, as you were saying.
Yeah.
So that's one thing to watch out for, the BFSI segment specifically.
Okay.
That will drive the outcome for IT in the next month or two.
Okay. The other thing that Nigel was also pointing out was Reliance, right? The leadership that we got, and of course comes out of the numbers next week. My question to you is on telecom, because finally we've got that tariff hike, and now the entire space is buzzing in a big way. Do you think that this is a structural upcycle that we're seeing in telecom? And once the numbers come out, do you think we could be headed for another positive surprise in Jio?
So the question becomes, will we see follow through tariff hikes more regularly rather than what we saw over the last few years, where we did not have a tariff hike for a prolonged period.
Yeah.
So I think it looks like this tariff hike is broadly digested in a way. It's passed through, done, not much resistance, showing up in earnings. Our analyst does think, generally speaking, there is still room for earnings upside, broadly, and a couple of names specifically, which again I can't talk individual stocks, but he does think there is earnings upside, despite the tariff hikes being announced and well known. So yes, there should be some momentum left.
Let me put it the other way. Would you look at telecom as a sector as a consumption play? Because now that's going to be a big consumption, and it's not like a few tariff hikes are going to cut down the consumption, so to speak. So in that sense, would you look at telecom as a consumption play? And within consumption, what would be your top bets? What would be your key bets to watch?
So look, consumption in India has been kind of a conundrum, upper and lower end. And telecom also kind of, if you want that answer, falls in that bracket. Till the lower end consumption starts picking up because of policy, because of economic growth, the upper end will drive. So as long as telecom tariff hikes plays directly to bottom line, but if the telecom businesses, specifically Indian companies, are able to cater to the upper end better, then yes. Otherwise, we have to wait for the mass market to pick up.
Okay.
And for the broader consumption, our preference, just like in a way we are reflecting what's been happening, is still for the upper end of the market segment.
Exactly.
Not yet. We are seeing early signs of rural recovery / mass consumption, but we possibly need more policy support before we get more bullish.
So do we expect the policy support in the budget, especially for the rural consumption?
So look, the way I'll answer that is, what do you mean by support? Will there be possibly some stimulus, a little bit? Question is extent. Okay. The real analysis to do is what scale of stimulus and what schemes. Like some schemes, just to preempt, have an immediate impact. Like if you cut taxes, it flows through to your pockets immediately, but doesn't flow through to the lower end of the population because they don't pay taxes. If you cut GST, it helps them immediately. But if you launch a scheme which will reach them over time, then the consumption stimulus is more longer term rather than short term. So it's not just a headline thing, you have to look at these nuances.
Okay, all right. Before we get to Nimesh, who wants to tell us about the earnings that have, the earnings season, what to expect. Gautam, I wanted to ask you about the auto space. They were the big movers this week. Suddenly there was this fear that maybe Mahindra is pulling back on pricing because demand is not as strong. How do you view this space? That's been one of the biggest performers. Mahindra, the auto pack on the whole. Your view, how are you all positioned out there?
So look, what happened, and we have a similar thing about, we are seeing early signs of rural recovery, early signs, and that's the hope building up in that space.
Okay.
Also about, obviously, the commentary around EVs, etc. Because this space has also been up and down. Demand trends on the upper end and the lower end. The way I would put it out is it still has to be more stock specific rather than broader sector, even now. And again, we'll look for specific elements of policy from the budget rather than taking a big, bold call now. So,
So what is the preference, but as of now? The PVs, the two-wheelers, CVs? What?
So PVs, generally speaking. Two-wheelers, the premium end rather than the mass end, even now.
Okay. Well, we have, of course, earnings season that we've just kicked off with TCS, but Nimesh has the entire list of what to expect from various industries in the first quarter. Nimesh, what are we looking at?
So if you look at the headline number, the Nifty earnings growth is going to be around 15 to 17% on a YOY basis. What will drive the earnings in this quarter? Financials will drive, energy, IT and telecom will be good. On the other side, metals likely on the pricing pressure and discretionary could drag the earnings. So that's the overall picture. But now coming to the individual sectors, because that's going to be quite interesting, right? So autos, it's expected to be a strong quarter, even in terms of EBITDA growth. But going forward, in terms of how the monsoon pans out and the commodity prices, that's going to be a key trigger as far as autos are concerned. Banks, while everybody seems to be bullish on the banking sector, but from an earning perspective, expect a moderation in earnings growth to continue, and there's going to be further NIM pressure as well for the banking sector. Cement, 5% volume growth is what Street is expecting, with market share shifting towards the large cap names. Consumer durables and consumer discretionary, both are expected to be either in line or softish, so to speak. But again, the budget would be a big trigger to watch out for in the consumption basket. In the oil and gas, the big sector to watch would be the OMCs. There's going to be a bit of a pressure in terms of margins as well in this quarter. But again, it's to do with the budget, and there could be many things for the oil and gas. So again, there could be a bit of a budget angle as well in the OMCs. As far as pharma, it's expected to be a healthy quarter, so expect good earnings there. The other big sector to watch would be specialty chemicals. I've been saying this for the last two earnings preview as well. This is the space to watch out, and now the sense is that this could be the last worst quarter, and from quarter 2 of FY25, you could see the commentary changing as well as the earnings changing as well. So that is one sector to watch. Telecom is going to be pretty much in line to muted. Metals and mining, again, is going to be a quite mixed bag. But the aluminum pack is likely to do well, is what the Street is expecting. So watch out for that. And technology, Rima has explained it very nicely. So it's going to be an interesting quarter for technology. And Infosys is something to watch out for, because the Street is anticipating that they will retain the guidance as well. In terms of individual names, I always look at the Citi report, and they put out some positive and negative surprises. In the positive surprises, the first stock to watch would be M&M. They expect a better product mix to help M&M to do well. GAIL on higher transmission volumes. PB Fintech is expected to report good numbers according to the Citi note, and so is Britannia and L&T Finance. These are a few names which are expected to do well. They also have a negative surprise list, which includes Titan, and we've already seen in the quarterly update that there's going to be a soft quarter for Titan. Asian Paints, again, while there was a small hike by Asian Paints a few days back, but in terms of earnings, it's going to be a soft quarter. The other stock in the banking space would be IndusInd Bank. Expect a weak quarter from them. Dr. Reddy's could surprise on the negative side according to the City note. So DRL in pharma would have been interesting to watch. And ICICI Pru Life, interestingly, even that is one name in the City note which says that margins may decline significantly for ICICI Pru Life. So again, that would be an interesting name to watch as far as Q1 is concerned.
Okay, all right. Nimish briefly mentioned about the metals pack as well, Gautam. And that's been one of the big outperformers. In anticipation that demand is coming, China is going to boost up some stimulus. But the stocks have already run a goodish bit. How do you all approach the pack? The option between ferrous and non-ferrous? And within that, what do you like?
So look, we don't currently have coverage, sadly, for that sector because of analyst turn. But again, look, it will be driven by exactly the point you made. What happens to China's policy? That's a delta for them, more than what happens locally.
Okay. What about capital goods? Because today UBS downgraded ABB. So it's not that there is no earnings visibility, but clearly you believe valuations leave limited upside. So what's the call on that sector?
So look, our analyst has been and broadly remains bullish on this pack overall. And our strategist also is overweight on industrial despite him being cautious on India, which is interesting. The argument is the framework which our analyst has been using is stock and segment. So I can't comment on individual stocks, but at an overall industrial pack, he remains quite bullish. There's very few stocks here and there. When he talks about valuation specifically, most of the pack is not cheap.
Yeah.
The headline valuations are quite heady.
1900.
Yeah. So it's a context of marrying the valuation versus the earnings momentum and surprise.
So positive on the sector, but on a few select names, you believe there is not much upside.
Upside more in the context of the earnings momentum. So where the earnings momentum seem to have peaked out or is going to disappoint versus street, that's where our analyst has taken a contrarian view.
Okay, well, let's do one thing. Let's take a quick commercial break on that note. When we come back, we'll continue to decode this week's market action. We'll put the spotlight on retail participation on the Wall Street. Stay tuned.